strategy applies in so many areas of life. Strategy is also important for businesses. And some of you may think that business set their strategy early on, then they just go out and drive. Well, that's not true. Sometimes they reset strategy if they find themselves in a ditch or in a valley of poor results, or if they just want to reset the strategy and tune it to really accelerate even further past their competitors. And they often announce their strategic plans to the public. And that's what McDonald's did recently this week. They announced a 4-year strategic plan. So what I thought I would do was take you a quick rewind to where they started to kind of draw the line, and so you could see how this strategic plan lines up with the history and how they're doing some things new and some things just to accelerate like they've always been doing. Let's dive in. McDonald's. Let's rewind really, really fast and also share something about a movie with you. 1940, Richard and Maurice McDonald's, they found the first McDonald's in San Bernardino, California, and they were 8 years later, in 1948, after operating for a while, they saw White Castle trying to do certain things to even faster get the burgers out the window so that people who ordered them, they could serve more people faster. And so the McDonald's brothers built what they called the Speedy Service System, and they were known as a fast follower of White Castle. A fast follower is a term they use in business to say, you saw somebody doing it, you thought you could do it better, and you implemented it and followed them, but you were very fast catching up to them, so they call it a fast follower. So that's the dawn of McDonald's and fast food and burgers. Along comes a guy named Ray Kroc, and he joins him in 1955 out selling basically franchises, early franchising for McDonald's. And he likes to say that he built the first one, but it was actually the 9th one, and he was a franchise sales agent. And in 1961, in a very contentious situation, he actually bought out the McDonald's partners for like $2 million, which back then was a giant stack of money. You can see it all here in the movie called The Founder. And this is Hollywood putting their spin on it and everything, but the essential story that you'll see in The Founder is correct, where Ray Kroc was, a bit of a jerk along the way at times, and you'll see about him, but he was a very strong business guy, and he drove like hell and built McDonald's on the franchise into what it is today. Which brings us to going public. They went public in 1965, so 4 years after he bought it from the McDonald brothers. Ray Kroc takes it public, and there are 12 splits since that time, stock split. So if you bought one share of stock in April of '65, or if your grandparents bought one, today it's 729 shares. And they pay dividends a couple times a year, McDonald's does. They announce dividends, and a dividend is for you owning a share of stock. Sometimes they say, hey, we're going to send you a 50-cent dividend, 50 cents per share of stock, and it gets paid to you. If you had held one share of stock since the IPO, you have received over $15,000 in dividends here in 2023. Wow, that's quite a bit. But you can also see from 1970, 1960, here's the IPO, 1970, 1980, 1990, 2000, something happens right here and off they go running. Well, we're going to see what that was, and now you can see where their stock is now, trading lower than 300, but I'm going to take you through it. So there's your quick history of public. A long ride for McDonald's, and suddenly an acceleration that starts right around 2005. So let's go take a look at that 2004, 2005 point to today with revenue and CEOs. First of all, take a look. 2005, oh, look what's happening to revenue. $19 billion, 20, 22, 22, 24, 27, 27, 28. Okay, you see that? Difference between there and there is almost $10 billion. There are some companies that aren't $10 billion, and McDonald's put a $10 billion company on top of the $19 billion company it was in 2005, and less than 15 years later, $10 billion bigger. Now you see why that stock took off, and there was great profits that were made in here. But there also is leadership. First of all, there was Jim Skinner that was CEO all the way up to 2012. He was then followed by Don Thompson. Don Thompson was CEO for a very short period of time, and actually at an annual meeting of the franchises, he actually celebrating, went back to his room and had a massive heart attack in his hotel room and passed away. And he was replaced by Steve Easterbrook. Steve Easterbrook would serve until 2019. So let's look at the track record. This CEO presided over a period of growth. Thompson takes it over. It's still leveled out at 27, 28, 27 billion dollars. But then something happened here in 2013. That was America became very health conscious, and there was a lot of very bad PR about the amount of sugar, sodium, and fat that was in McDonald's foods, and how it wasn't as good for kids as you might have thought it was. Oh, it's a harmless hamburger meal, and people saying, no, you got to look at the amount of soda and the amount of sugar that's in there, the fat that's in the French fries and stuff. Suddenly people realizing that is not really a healthy meal alternative, and there is a lot of backlash against that. At the same time, this guy named Steve Easterbrook became CEO, and some things happened with him, apparently, and we only know what we read in the media, but he was, apparently, he was caught dipping the French fry with a co-worker, and he was summarily fired. And so he was replaced by Chris Kempczynski. Now take a look here. So you've got all the health food issues going on, you've got poor results, all the way down to $19 billion. Wait a minute. $19 billion is what it was in 2005. $19 billion, 120 million, 2005. You're all the way down here, 2020. 15 years later, you're back where you started from. Look at that. But there's been some pop-up. Gee, I wonder what's going on. Maybe there's a new strategy. Maybe there's a strong leader following a leader that left in disgrace, and there's some things happening there that deserve a look, and maybe it's helping to drive the valuation of McDonald's and investor confidence in this dividend-paying stock. Okay, now let's dive into that strategy. So for the last 5 years, you look at the stock performance. We know Easterbrook, he goes to 19, so you get over here into 19, and then 2019, we are right here at 250, and we get above 250, and back to 250, and then right now we're at 285. So over 5 years, it's up 73.59%, and a lot of that is Chris's leadership. So the stock's nearly doubled over those 5 years. At 300, it would double over the 150. It says, and market cap is now a little over 200 billion. I think it's close to 207, 210, something like that right now as we film this in the first weeks of December 2023. And as you can see, there was a COVID drop, shut down, can't go to restaurants, can't do this stuff. And so they have a COVID drop and recovery, and then a growth and jump back in line with the market as a whole. And then here, getting above 250, flirting with 300, and some good things coming on here, and let's find out why. Makes sense. So now it's like, if they really want to go, you've got your new CEO, our guy Chris, and he's driving, and what's he doing? Well, for the past 5 years, let's take a look at this. So Easterbrook leaves, remember the guy that was dipping the French fry, right there, 21 million, 19 billion, 19 billion, 23 billion, 23 billion, and the trailing 12 months, boom, $25 billion. Now let's take a look at earnings per share, because that's what makes stock go up. EPS and good news typically make stock go up. Low EPS, bad news, bad forward estimates and assessment of your future usually makes your stock go down. So $8.07 earnings per share there. Right now, trailing 12, $11 earnings per share. Well, that may not seem like a lot, but $12 there would be 50% up on earnings per share. That is significant. What's equally significant, take a look at the gross margin here, from 52% to 57.2. That's 5 more percentage points of gross margin. That helps drive this. As a matter of fact, gross margin, unless you have a lot of debt and a lot of balance sheet transactions, and I won't go into what that's all about, that consumed cash, that also affects the certain representations and calculations of net income for a public company, boom, your EPS gets driven very, very significantly by your gross margin. Gross margin is your ability to sell something, subtract the cost of building whatever that something is, a hamburger, and saying, what do you have left to pay your operating expenses, your headquarters, your people, everybody that's not involved in just making that burger. And away you go. So financials for the last 5 years are getting stronger, back to back toward $25 million. And we go back here real fast, boom, 25. Last time they saw 25 was 2015, and we are almost coming up on 8 years since that and getting back to there. So good job by Chris Kempczynski. And away we go back to it. So now, let's look at the facts and positioning today as McDonald's thinks about the strategy for tomorrow. First of all, did you know McDonald's is one of the top 5 most valuable brands in the world? When you think of Nike, Coca-Cola, McDonald's, nonetheless, there are marketing experts out there that say they are one of the top 5 most valuable brands in the world. And 150 million users, 90-day active rate, are using their app to order food, and they're yielding $20 billion in TTM, what they call system-wide sales, I believe that figure is. And at any given time, there's 55,000 delivery orders at any given time being prepared. Isn't that interesting? And they serve 69 million customers per day, every day around the world. There are 40,000 locations. That's the most of any chain in the world, covering 118 countries. And look at this, the US only has 14,000 of those. California has 1,200 of them. So you can see this is a global company. 26,000 locations are outside the United States. So you might think of it as a US brand, but you know, that's not true. They're very much a global brand now. Then 27,000 drive-through locations, most in the world. And believe it or not, they point out that 17 menu items that they have are individually branded as brands that are valuable as $1 billion or more, such as the Big Mac. Supposedly, that is a $1 billion brand. If they ever wanted to sell that to somebody, they'd want $1 billion for the whole Big Mac as a trade name brand. Amazing stuff, really amazing stuff. So that's where they are today. So where are they going? And what is this 4D strategic plan? So Chris comes out and says, this is going to be our fastest period of growth. That's saying something when, per a chart I'm about to show you. First of all, he says the first D is digital. They want to have $250 million using those apps and double, in 4 years, double the amount of sales that are made through the app. So if you think of Starbucks in the app, and if you haven't been into Starbucks lately, you go to the line, there's a whole section of the counter that will have the drinks set up in these little wooden trays, and they've got names on them, and you have people coming in there and not wanting to touch somebody else's drink, looking for their name, and there's tons of them there, tons of them. The Starbucks app is rocking. Well, guess what? McDonald's wants to get its app rocking like that is. I'm sure you know what I mean. You go into Starbucks and you realize that, like, for every person at the counter, there's one person picking up. At least that's what I notice in the morning at my Starbucks. So, you know, I don't know what the percent is, but McDonald's is heading down the same path. They want people to order, come in, get. So digital is the first one. Then delivery. Currently, they say they have the largest delivery program in the fast food industry, and 30% of orders are originating by mobile. Okay, here we go. You see where this is going. You know, less people walking into McDonald's to stay in line to say, hey, I want a number 8. And they say, supersize it, you know, whatever. That, I don't know if they do that anymore, but you get what I mean. So delivery. Then drive-through. They said they want to make drive-thrus even more efficient and add even more speed. They want the credit card to be right there at the speaker. You buy, you use the credit card, you go in. If you've been to Sonic, you know they have a lot in the Midwest, and they have tons of hot dogs. I think they're more or less known for hot dogs and a few other things. But you know, you go there and you buy right at the window, and you put your credit card in right there, and then they walk right out to your car with it. So it's sort of a drive-up model, but the point is use your card right at the point of ordering, so it's done. You don't have to go to a second window and pay somebody. McDonald's is talking about speed, efficiency, payment alternatives. So drive-through, digital, delivery, drive-through. There's 3 Ds. And the fourth, development. They said, we want to get to 50,000 locations by the end of 2027. What? You know, incredible, in 4 years. And we have got Google AI. We did a deal with Google, and they have integrated their AI into our systems to make our systems smarter, our ordering smarter, you know, what things do we feature smarter, our pricing smarter, and basically understanding what the consumer wants smarter and more ready to serve the next consumer. So they're talking about Google AI. They've made an announcement. There's a press release and talking about it. I got the CEO of Google, you know, it quoted in the release. So this is real. This is not just them saying, yeah, we're going to use Google AI. No, there's a big deal that was made out of this, and they have got a real partnership. So there's the plan. Now let's take a look at this. So check this out. 1962, so we have 9 stores. Ray Kroc, 1961, buys out the McDonald's brothers. And then you get down here to like 1989, 1990 timeframe, 10,000th store opens. And then you get here, your 30,000th store right here around 2001, 2002. So now you're at 20,000, and they're pointing out that, 30,000. So this was another 20,000 stores here in this time frame, and they're pointing out it then took 20 years from 02 to 2022, 23, where we are now, to go from 30 to 40,000 stores, and they're like, and they want to do the next 10,000 stores in a quarter of the time. So you can see, look at the slope of this growth and compare it to here. The heyday growth from 1989 to 2002, 3, 4. You look at the amazing vertical growth they have there, and they're coming back and saying, this will be the fastest growth in our history. That's pretty impressive when you think about it. So that's what they're talking about, using that 4D plan and scaling. Now, there's something else, because they're not resting on it. There's other things happening in fast food or fast pickup, quick pickup. There's a lot of phrases for it. And do you know what this is? CosMc's. See that? There's a little McDonald's there, and there's a golden arch right there. This is the first location of CosMc's. This is pronounced CosMc's, focus on drinks, a lot of coffee drinks and coffee, focusing on the afternoon pickup market and some morning coffee market, plus some snack items, but not a lot of food the way a regular McDonald's is. This is the test location in Bolingbrook, Illinois, and I have some screenshots here from Fox, from Eyewitness News, ABC, giving credit to the the news stations that are there in and around Bolingbrook, Illinois. And that's where the test location is. They're going to build 9 more in 2024, spread between Texas and Illinois, and they're going to stop, and they're going to spend 1 year to evaluate this. So a lot of people are saying, hey, wait a minute. They're inventing a Starbucks with 4 drive-up lanes, highly focused on coffee drinks and a few flavor drinks. And Starbucks has got those flavor teas and stuff, the hibiscus tea and whatnot, focusing on that, and then a few menu items, snack items. So if you like me, I think they're going after kind of the drive-up Starbucks as another opportunity to have an engagement with the customer, and it's simply called CosMc's. There you go. And so they're going to be testing that. So, as I keep saying, Steve, the CEO, is driving right now. And not only is he's got a 4D plan to focus on things they're already doing, like efficiency, data, drive up, and things like that, they are now also running an experiment, and they've got the kind of money to pull off the experiment to take a year to look and see if these are going to be successful. And if they are, they're coming. You're going to see a lot of these. And that's an important thing. So he's looking for the next innovative campaign to go with the success that he already had. So what are the lessons for you and me? First of all, mature companies can and should innovate, right? I'm going to take you through the Ansoft model, where you rate the 4 strategic alternatives on a 1 to 10 scale in difficulty. You start out with market penetration. From wherever you are now, you say, what do we have? Well, we have about 5% market share. Okay, if we can go to the same market with the same product and go deeper, let's go to 10% market share, 15% market share. So that's called increasing your market penetration. And on a 1 to 10, the difficulty is usually only a 3. It's your normal customers, normal distribution, everything. You're probably discounting prices or opening more points of distribution in the same footprint with the same market, same price. And so, but you can end up in a red ocean where you end up in a price war with people for the sake of getting more market share. But nonetheless, it is one of the 4 options in the Ansoft model. Option 2, product development. It's a difficulty level 5. It's the same market, but new products. Let me give you an example. Let's say you're making beach flip-flops, and you decide you're also going to make sun hats. The hats with the big bills that are made with the UV fabric. And so you're going to see the same market, surfers and beachgoers, but a new product. You go from flip-flops to the hats, so they're sold roughly in the same kind of storage. Beach stores, things like that. So that's a product development strategy where you're selling a different product to the same people buying your current product, and you know a lot about them, you know a lot about the distribution. On a 1 to 10, that difficulty is a 5. Goes up in difficulty because you don't know if they're going to like the new product the way they like the old product, and away you go. The next level, market development, difficulty level 6. It's a new market for the same product. Maybe you're trying to take your beach sandals and now go to Brazil. Brazil's got a lot of, coastal cities and everything. Maybe I go down there with my beach flip-flops. But do they buy them and wear them the same way they do in the US? Do they wear them casually? Are they the same colors? Are they different? What is their expectation? What is their style? What's typical? That's why it's a 6. Where you take your product and you go rolling into a new market, and they may not use it, they may not like it, the style may be wrong, and you may just fail. So it's a little bit more difficult. It's a 6. And the fourth option in the Ansoft strategic is diversification. Difficulty level 8. Well, that sounds pretty difficult. Why? That's new products in a new market. Back to the example, maybe you decide you're going to make sunscreen that goes with your brand for your flip-flops because it's recognized with by consumers. So that's sunscreen, but that's a whole new market. The market for people buying beach fashion and the market for people that are buying sunscreen and skincare for people who spend a lot of time in the outdoors is not necessarily the same. Or going to Brazil with sun hats. You've never been down there. So it's new products, new markets. So diversification strategy is a level 8. And I'm highly summarizing this and just doing the best I can to kind of use something simple, an example of beach flip-flops and sun hats and stuff. But you see the point. So this is the strategic options that are in the Ansoft model that big companies and new companies can look at. But by far, the most important thing is to stay curious and push your team. What should we do next? What should we do next? Always get them thinking. Don't turn the ship every time somebody says, sunscreen, beach hats. No, but get people talking about it and do your research. Determine what you could sell it for, what the consumer is willing to buy, and then go out and check it out and see if you can pull it off. That's what it's about. Those are lessons for you and me. Now, last week, you asked about books that I mentioned from time to time. And since we're talking strategy, I'm going to mention 2 of them. Blue Ocean Strategy. New and old companies can win by applying the Blue Ocean Strategy to reposition their company. And maybe you have a single product focus, and they use a big example of Cirque du Soleil that used Blue Ocean Strategy to put itself in a very unique position in sort of theatrical presentation. And by using the Blue Ocean strategic grid. Also, a company may be thinking of introducing a new product, and the new product may be introduced in a certain way that it's a Blue Ocean product issued by an existing company. They also follow strategic grid. So Blue Ocean Strategy helps you apply a grid to your thinking and strategy as you introduce new products or new companies or whatever your concept is, so that you are in a blue ocean all to yourself rather than a red ocean filling with blood as all the sharks are attacking each other. And the sharks is you and other companies, usually in a price war to death. That's a red ocean. So Blue Ocean is always on my shelf out there because of the way the strategic grid is so wonderful and applicable to your strategic thinking. The other is The Innovator's Dilemma. Clayton Christensen, one of my favorite business authors. Some companies fall behind because they fail to apply strategy, such as they put too great an emphasis on just satisfying the current customer's needs. Flip-flops. Let's just make better and more comfortable flip-flops and focus on them. That's all we should do. Don't worry about it. Don't worry about it. And then all of a sudden they notice that people are using different technology to make flip-flops that aren't flat. They're kind of contoured to your foot with a little bit better sole on them, but it's still as comfortable as a flip-flop. But now it's actually better for you and your feet don't get as tired all day. And guess what? So if they fail to adapt, they could fall behind. And so that's an example of just milk it, baby. Just milk those current customers, keep them happy, and don't worry about what's coming. Especially if it's technology, that could be a problem. Then companies establish business that, put this great focus on spending money on only enhancing the performance and efficiency of the products rather than looking forward and adopting change. So if you just focus on your customer's needs and you're only asking the customer what they need today, you're probably never going to find yourself on an innovative line. Likewise, if you're spending only money on enhancing the performance and efficiency of the current product and ignoring what's happening around you, this is the innovator's dilemma. where those revolution could cause your company to fall behind and even lose position. So those two books, Clayton Christensen, The Innovator's Dilemma, and Blue Ocean Strategy, in terms of strategy, which is what we're talking about with McDonald's today, I think are great ones to add to your bookshelf. And that, my friends, is the case study on McDonald's and its 4-year strategy, along with a little look back as to what brought them to today, and a couple book recommendations and the Ansoft Model, so you could think about what you do with your company. And now what I think I'm going to do, I hope I've unlocked your brain. Unlock your brain with Vault. Remember, you can get them at Amazon. Black cherry, watermelon, cucumber mint, great flavors. Unlock your brain. No sugar, no caffeine, but it gives you a nice pump. So until next time, says I'm looking forward to unlocking my brain with another Vault, and I'm looking forward to another case study for you. Now let's go back to the main studio and wrap up. All right. I hope you enjoyed that as much as I did. It's an old company, McDonald's, that's doing some new things strategically, and I hope that was valuable for your business so you can think about how you might apply that or those principles, or check out those books that I just referenced. All of it to make you better, your business better, whether you're running a t-shirt company in Berlin or a technology company in California. And if you like that case study, here's 2 others that you can check out from the Biz Doc archive. Hope you get something out of them as well. Until next time, I'm Tom Elser with the Biz Doc, and I hope I left you better than I found you.